There is a very particular quiet that settles over Wall Street on a Friday night. Most of the time, it is a calm, satisfied silence. The trading week has ended. Screens go dark. Phones stop ringing. Bankers head off to their homes in the Hamptons, celebrating another completed week. But this weekend, that quiet feels different. This is not relief. This is tension. It is the kind of silence that follows a mistake, when something has gone wrong and there is no way to fix it yet. We just saw something that was never supposed to happen. For 40 years, the same pattern has played out again and again. Silver was expected to break down on Friday. That was the plan. They pushed against it at $65. They pushed again at $66. But instead of collapsing, the market pushed back. Not only did it hold, it surged. The screen now shows a closing price of $67.14. Take a moment to absorb that number, $67.14. This was not a minor breakout. Resistance didn't just fail, it disappeared. The market closed at the highest level of the entire week. For everyday investors, this feels like a victory. But inside the risk departments of the major bullion banks, this is a worst-case outcome. The reason is simple. Markets are closed. Positions cannot be adjusted. These banks are sitting on billions of dollars in short exposure that is now deeply unprofitable. And for the next 48 hours, they are trapped. They cannot trade, they cannot hedge, they cannot stop the losses from growing. In this emergency market update, we are going inside that situation. We will explain what a weekend margin call really looks like. We will break down why this exact closing price changes the math for the entire silver market. And we will talk about what Monday morning could bring. Because when a market shuts down at the highs on a Friday, it almost never reopens quietly. Pressure is building behind closed doors, and once those doors open, everything moves at once. This is the story of the weekend when control slipped away from the banks. To understand why $67 matters so much, you have to understand the long-running Friday pattern. For decades, silver investors learned to expect disappointment at the end of the week. Prices would rise Monday through Thursday, optimism would build. Then, almost like clockwork, around 10 a.m. New York time on Friday, a massive sell order would slam into the futures market. Silver would drop $2. The week would end weak. That pattern was intentional. It was meant to spoil confidence and make holding silver feel foolish. This week, we saw the same attempt. We saw the dip. We saw the effort to force the price below $65. This time, the buyers did not flinch. Instead of selling into the close, they stepped in aggressively. They lifted every offer. They cleared the order book. They drove the price higher right up to the final bell. That behavior matters. It signals a shift. It tells us the suppression system failed. The banks used their firepower and it wasn't enough. They ran out of selling pressure before the market ran out of buyers. When a market closes at its highs, it sends one clear message. Not fear of collapse, but fear of missing out. Buyers were not worried about price. They wanted exposure before the weekend. They believe something important is coming, and they did not want to be left behind. Now imagine this from the perspective of a commercial short seller. You are a bank. You sold silver at $64, expecting to deliver it later. Your plan was simple. Let the price fall, buy it back at $60, and pocket the difference. Instead, the price is $67.14. You are losing more than $3 per ounce on millions of ounces. And the market is closed. You cannot escape the position. All weekend long, you are forced to watch the news. Rising geopolitical tension, headlines about Samsung battery demand, reports of solar shortages. Every story increases the pressure because when Asian markets open on Sunday night, everyone else will see the same information. If Asia pushes the price to $68, your losses grow immediately. This creates extreme psychological stress. Bank risk managers are now running worst-case scenarios. They are asking questions like, what if silver opens at $70, and can we survive that? If the answer is no, there is only one solution. They must buy at the open, no matter the price. Traders are given simple instructions: buy everything. That is how a gap and go begins. All the fear that built up over the weekend releases in the first minute of trading. This setup points to one of the most aggressive market opens we have ever seen. So why is 67.14 such a key level? From a technical standpoint, it clears the noise. Between $60 and $65, silver chopped back and forth. But above 67, there is very little trading history. If you study monthly charts going back 40 years, you will see almost nothing at these prices. This is open territory. There are no long-term holders waiting to sell just to break even. Everyone holding silver today is in profit, and people in profit tend to hold, not panic sell. That removes overhead resistance. What remains are psychological numbers like $70 and $75. These are mental markers, not real barriers. That is why 67.14 signals a shift from conflict to discovery. In discovery, prices move quickly as the market searches for a new balance, and given the physical shortage, that balance is much higher. Still, we need to stay grounded. Excitement is justified, but caution matters. When markets move straight up and close at extremes, they attract short-term traders at heavy leverage. These players place tight stop losses. If banks manage to force a $2 drop on Monday, those stops get hit all at once, accelerating the decline. That means while 67.14 is very bullish, it also raises the risk of a sharp shakeout. The higher price rises without rest, the more intense the pullback can be. We could see a retest of $65. We could see a scary morning with a $3 drop. That does not change the trend. Corrections are healthy. Crashes signal failure. Given the shortages, battery demand, recycling limits, and empty vaults, a true crash is unlikely. Any drop is simply the market testing conviction. So the price is high and the shorts are stuck. But what are the banks actually doing right now? It is the weekend. Markets are closed, but office lights are still on. In part 2, we go inside the weekend margin call. We will explain exactly what happens inside a prime brokerage when a client collapses. We will discuss the risk of defaults by smaller funds or bullion dealers. And we will examine the physical rush underway. At these prices, people are not selling silver. They are trying to secure it before it reaches 100. The supply chain breakdown is happening in real time. The price is the signal. The panic is real. Stay with us for part 2. If you are just joining, let's reset the situation. It is Saturday, December 20th. Markets are closed. Silver is frozen at $67.14 on trading screens. From the outside, finance appears quiet, but inside the glass towers of Manhattan and London, activity has not stopped. In part 1, we covered the broken pattern. Now we go deeper. Every major bank has a risk department designed to prevent disaster. Right now, those teams are staring at spreadsheets full of losses. They are reviewing short positions held by clients who bet against silver, and they are realizing many of those clients no longer have the money to cover their losses. In part 2, we explain how weekend margin calls work. We show why phone calls are happening right now that will force massive buying on Monday morning. We examine the freeze in physical markets where dealers stop selling because they cannot replace inventory. And we reveal how unallocated silver promises are being challenged by the wealthiest investors. The price is high, but the fear is even higher. Most people believe margin calls are instant. A red alert flashes and positions close automatically. That is true for small traders. Institutional money works differently. Large funds operate on variation margin. Each day, gains and losses are settled in cash. Normally, this is manageable. Friday was not normal. The move to 67.14 was sudden and violent. Many funds were highly leveraged and betting on a pullback. When Friday ended, their losses exceeded available cash. Saturday morning, the phone rings. The prime broker informs the hedge fund manager, "You are down $500 million. Your credit limit is breached. You must wire $300 million by 8 a.m. Monday." The manager responds that banks are closed and assets must be sold first. The broker replies that if the money does not arrive by 8:01 a.m., liquidation begins. That is forced buying. Belief does not matter. Strategy does not matter. Cash does. The bank takes control and closes the position. Since the fund was short, closing means buying at any price. This is how gaps form. It is not optimism, it is fear. Now look at the physical market. Coin shops, online dealers, wholesalers. They are under pressure. A dealer sells 1,000 ounces at $64 on Friday, expecting to replace them at $63. Now the price is $67.14, and premiums are rising. Replacing that inventory might cost $70. That is a $6,000 loss. This is replacement risk. In fast bull markets, selling inventory can destroy a business, so dealers freeze. Websites show sold-out notices. Others enter maintenance mode. Some raise prices to $80 to stop orders. Supply disappears while demand explodes. This imbalance creates powerful upward pressure. At the top level, unallocated silver accounts become critical. Banks hold billions of ounces on behalf of wealthy clients, most without specific bars assigned. As prices rise and shortage rumors spread, those clients demand allocation. Put my name on the bar. Show me the serial number. If the bank does not have the metal, it must buy it immediately. They cannot refuse. That would trigger lawsuits and panic. So they pay whatever is required. $68, $70. This internal scramble supports price strength behind the scenes. When Sunday night arrives, hedge funds face calls. Dealers need inventory, and banks need metal. Who is selling? Almost no one. This imbalance causes price gaps. A close at $67.14 can reopen at $68.50. Shorts are filled higher. Losses expand instantly. If this happens, it confirms systemic stress and opens the path to $72 by Tuesday. In Part 3, we follow the metal. While paper markets are closed, physical silver is moving east. Ships, planes, trucks. London and New York vaults are draining. Shanghai is paying more. COMEX closed at $67.14, but Shanghai trades near $72. That $5 gap pulls supply east. Every bar flows to the higher price. Western vaults empty while Asia accumulates. Industrial buyers are bypassing futures entirely. Samsung, Tesla, and others are buying directly from miners. 2-year contracts at $70 picked up at the mine. That silver never reaches COMEX. Public markets see supply. Private markets see shortage. This split breaks price discovery.
The spot price is becoming symbolic. Dealers do not sell at $67.14. They quote $78. Paper prices are reference numbers, not transaction prices. This divergence signals stress in the system. Registered COMEX inventory continues to fall. If it approaches zero, settlement fails and cash replaces metal. That ends trust. This brings us to Part 4, the plan for Monday. Watch the Sunday open, but do not trade it. Liquidity is thin. Tricks are common. Let Monday settle. If silver gaps to $69, resist FOMO. Gaps often fill. Buying the spike risks immediate losses. Wait for a retest near $67. If it holds, that is strength. $70 is the next psychological battlefield. Expect resistance. Expect volatility. A pause is not failure. It is digestion. If price drops below $65, reassess. That would suggest delay, not defeat. Fundamentals remain unchanged. Physical silver has no margin call. It ignores noise. This week closed at the highs. Suppression failed. The trend flipped. Metal is flowing east. The repricing is global. It will not be smooth, but it will continue. So here is the plan. Observe the gap. Watch the retest. Trust structure, not headlines. $67.14 is not the destination. It is the signpost. Stay focused, stay prepared, and we will meet the market on the other side of the open.